Skipper with Skipper Realty Group, brokered by eXp Realty, and my buddy Cody Wilhelm is with Residential Mortgage. We are going to talk today. Hey, Cody, by the way, I should be
Hey,
kind and say hi. I'm just getting
hey.
right into it. But
Jump on in.
I know. We are going to get into assumable mortgages today. It's a big topic in both sides of the camp of lending and real estate. With real estate, I'm being asked by buyers and sellers on both ends, how do I get into an assumable mortgage because there's a potential for a great rate, and sellers are saying, well, how do I market the home as an assumable mortgage, and how do I know if it's an assumable mortgage? So I think it's a good topic. I think it's a good one for us to get into and kind of uh, see what questions we have, or see what goes on with that. You can explain that, Cody. I have some
hmm
questions for you, and then if anyone in the audience wants to ask any questions, beside not only with assumable mortgages, but with anything regarding real estate or lending, let us know and we'll cover that. So right now,
hmm
Cody, I just wanted to again talk about assumable mortgages. So if you could just start with the basics, like what is an assumable mortgage within your industry? What does it mean?
Yep. So an assumable mortgage is it's really kind of what it sounds like, but it allows you as a buyer to purchase the home that you're looking at using the seller's mortgage. So for example, if as a seller they have a $300,000 mortgage on that property and it's an assumable loan, you as a buyer, rather than going out and getting a new mortgage with today's rates, you can qualify and assume to take over their existing mortgage. So, for reference, maybe they have a 3% or a 4% interest rate, and you're looking at the current market being maybe somewhere in the sevens or eights. You can take over their loan. That way, the bulk of your mortgage is based on their lower interest rate. So, it's a simple process in the sense of what you're accomplishing, but you do still have to qualify through the seller's lender. So you would reach out directly to the seller's lender for them to qualify you, just like they would qualify you, like we would qualify you for purchasing a new mortgage.
Okay, so that's going to open up a little bit more questions for me about
Yeah.
that. So they would go, they're not going to go with their traditional lender. They're going to go directly to the seller. And
hmm
we'll skip around a little bit, but so that leads me to what's next. So say they have a $300,000 mortgage,
hmm
that is assumable, that is officially assumable, and the house is selling for $500,000. Where do you go with that as the buyer?
hmm
To get that extra 200K, where do we go? Is it a traditional mortgage, or do we have to do something different?
Yeah, so that's where it's going to get a little bit more tricky. So, like in your scenario there, say you're taking over a $300,000 mortgage and you're buying it for 500. So you get approved and you take that over. So now you have three of the 500,000 accounted for. The other 200, or I guess it's going to be less than that by the time you factor in down payment and everything. But that's going to need to be figured out through a couple different ways. One is going to be, if you have that down payment money, you can apply that. So you're applying essentially $200,000. So now you're just carrying that 300,000. If you don't have that, that's where you're going to have to get a little bit more creative, and there's got to be some. It's something that you're really going to want to kind of plan out in advance. But there's a couple different ways you can do a standalone second, which is just kind of like what it sounds like. So your first mortgage would be that 300,000, and then you would need to take out a second mortgage for the remaining balance. So between the two of those, it covers what you need for it to cover. Um, so you're going to have two loans, two interest rates, two payments. You can also do, a home equity line of credit. There's things called bridge loans. Those are a little bit more kind of short term, like it sounds, a bridge. So you're kind of bridging that gap to get you there. But where it can get tricky though is if you take out a home equity line of credit and then you're planning on selling that home that you took out that line of credit on. That's really kind of where it's considered more of a bridge loan, but you run out of that equity because you now sold that home. So
Yeah.
a standalone second is kind of going to be the most traditional way, as well as the cash out of pocket. So it's something that you really want to plan for in advance, because if there is a big gap like that, say it's 200,000, that's a big chunk of money that needs to be brought to the table. It's a
Yeah.
lot more attractive if you had a $500,000 purchase and the sellers maybe had only been there for a little while, a couple years, and their loan was at 430,000.
Yeah,
That gap is
absolutely.
a lot smaller. It's a lot more manageable to get in there.
Okay. And
Yeah.
so does the lender do they have to use, so say you could get that other mortgage for the
Mhm.
difference. Can they use, do they have to go through the seller's lender, or can they use someone like you to do that portion and then just take over the other one?
Yeah, they can go through a separate lender for the remaining balance.
Okay.
They would just be getting approved with two different lenders.
Okay.
And then it's going to be both lenders are going to need to know what those numbers are so that
Okay.
they can factor that into the qualifying. Because if the original lender is qualifying them for 300, they need to also know if they're bringing in an additional loan so that the numbers, the debt to income, everything
That makes
qualifies
sense.
that they're going to be able to not default on the loan. But yeah, you can go through separate people, but the seller's lender is the one that you'll need to get to with the process of assuming that loan.
Okay. And so, what I get from sellers a lot is, or at least a lot lately, is I heard my friend says, check if your loan's assumable before you start listing and things like that.
Mm-hmm.
So, is every loan assumable or no?
No, no. Like typically, it's only going to be what we call government loans, which are going to be FHA, VA, and USDA loans.
Okay.
So those three are going to be the ones that are typically assumable. Conventional loans are not. It's not to say that they are never assumable, but they're not commonly assumed. And the way to really know, if you're curious, if you have one of those three loans, the FHA, VA, or USDA, more than likely it is assumable, but you just want to reach out to your current servicer. Or if you still have your paperwork from when you signed on that loan, it will say in there, this loan is assumable or this loan is
Okay.
not assumable. So I know it's a lot of paperwork when people are purchasing or refinancing to look through and read it all, but it does show on there initially that their loan is or isn't assumable. So if you have a conventional loan, like I said, more than likely it's not assumable, but with
Okay.
the government loans, they are.
So it's is it safe to say, for someone that has a VA loan or an FHA loan, are they automatically assumable, or should they still check with their provider, or what should they what should they do?
Yeah, they're going to want to check with the current servicer, no matter what, just to double check,
Okay.
because there are some loan types. Say it was a FHA loan, but maybe it was done as a down payment assistance loan through a separate agency. Maybe that one is not assumable, even though the
Okay.
main loan itself is an FHA loan. So there can be some little quirks that you just want to double check on, because if you assume that, you might be assuming other qualities of the loan, not just the typical
Yeah.
FHA loan with it. So definitely, I would reach out if it's something. Reach out to that existing lender, have them look it up, and make sure that it is assumable.
Okay. And
Yeah,
I've been getting mixed signals on this, since this has become more popular now that the rates are extremely high and people want to
yeah,
get into a low rate. What the timeline's an issue. I've heard
yeah.
anywhere between 6 and a year, 6 months to a
Hmm.
year, but I've also heard people say that it's closed in 45 days. Is that
Yeah.
particular to the lender, or is that just because it's a new thing, or a combination of both?
It's going to be a little bit of both. I think it's going to be more on the lender side, who you're working with and who they have working on it. I, from what I have heard from people that I know that have experienced it, more so on the buyer side rather than the lender who is doing the assumption. It's closer to 90 days,
Okay.
and so it's a little bit more of a process because for them there's just they just have to do a lot more digging to really make sure. Then there's transferring of all the paperwork and everything. So I would, from what I'm seeing and hearing, I would assume 90 days is probably going to be your target there, to be able to get you through, because you're essentially, as the buyer, you're doing, if you need a second loan, you're doing two separate transactions for that. So they all
Yeah.
just take time, and you wouldn't necessarily want to start getting your second loan squared away when you don't know if you're approved for the assumption. So it's just more legwork to it, more process to it. But yeah, I would plan for, it's going to be a little bit of a long process to get
Okay.
everything squared away. A lot longer than the normal 30-day process of purchasing a home.
And this may be diving into the weeds a little bit, but I was talking to a client the other day, and they were asking, what's the incentive, or I guess, maybe the banks put it in there. Like, what's the incentive for the banks to make it assumable? Because it almost hurts the banks or the
Hmm.
lenders in certain ways to say assume this loan versus buy a home at a
Sure.
higher rate for with us. Like, what was the thought, or did you even know? Like, I guess I just was curious of
Yeah.
why it's assumable. Is it
You
just
know, it's a good question, and the only thing that I can assume from that is that it's a benefit to getting that type of loan. So it's a selling point for you as a buyer to use that type of loan.
okay?
So it's more of an incentive to use a assumable loan for a climate like this. Like we've been it's been so long since assumable loans are even a thing. Like
Yeah, yeah.
they've always been assumable, to my knowledge, at least since I've been doing it, but it's not been a talking point. But I was looking earlier, and so one reason why they are so popular, obviously our rates are higher than what they've been in recent past, but 82% of homeowners right now have an interest rate of below 5%, and 62% of homeowners have a rate below 4%. So, that kind of just speaks to where a lot of these current owners are with their mortgage. And that can be a
Hmm.
difference of thousands of dollars a month for someone. So assuming it, even though the process is a little bit cumbersome and might kind of beat you up during it, it is well worth it to save that
Yeah.
money. And I think, as the original, the loan type, the ones that are supporting this whole thing, I think for them the end goal is to keep it affordable for people. So this being a way for that to be able to stay there rather than those rates just going
Hmm.
away permanently, it's still a way for somebody to be able to obtain that in a tougher market like it is right now.
Yeah, and I think, just anecdotally, what I've been seeing and we may see this more and more, just becoming almost not necessarily standard, but more and more of a normal process to assume a mortgage because, like you
Hmm.
said, that those stats are staggering at below 5%. And if we never get close to there, or, we don't know it, there's theories that we could get close to 5 again and stuff, but if
Yeah,
we're not, people may be like, let me save up, let me figure out how to do a smaller mortgage or smaller loan, to cover that gap of the sales price versus the mortgage,
yeah,
the assumed mortgage, and get into a home that they wouldn't be getting into without it.
absolutely.
So
Yeah, I mean
um,
it's a historically low rate environment that we were in through 20 and 21. So to be able to still keep those rates to some extent for people, I think
mhm.
it is well worth it for anyone that's looking to do it, and the seller being good with that process. And again, the timeline is really kind of what can cause a little bit of an issue.
Yeah.
But yeah, it's well worth it.
Yeah, and I kind of, and I didn't know if we were going to get into this topic but I think it's important, which leads me to the HELOC.
Hmm.
Having money on hand for things that when you do want to buy, um and I think maybe we'll get into it into a deeper detail next week. Maybe we'll talk deeper into HELOCs and what they're all about. But
Hmm.
my suggestion to anyone that's paying attention is, and you can correct me if you don't think I'm right, is to get a HELOC, even if you don't need it right now, even if you're not using it. I think it allows you, and some lenders are different, so some lenders will allow you to use it for a down payment, some lenders won't.
Hmm.
And but it's just available to you. It's money that you can have on hand, that if you did get into something like this and you have a HELOC that can maybe support a little bit of it, or support a down payment. I think especially in this market where we have to be a little bit more tricky in how we get into homes. Not tricky,
Hmm.
that's a bad term to use, but a little bit more thoughtful in how we get into homes. I think a HELOC, is a common sense thing to
Yeah,
get into. And so if you just want to
absolutely.
kind of quickly go into that, just to kind of overview that. And
Yep.
you guys do HELOCs with residential?
We don't do HELOCs. We do a
Okay.
standalone second. So it would
Okay.
be with a purchase. So, kind of bridging the gap like we were talking about with the
Yeah.
assumable loans or whatever it might be. And really the main difference with that would just be the second loan. You're not necessarily taking the equity out of, and it's an adjustable line of credit,
Hmm.
versus the HELOC being a home equity line of credit. But there are some lenders out there that will do it with very minimal fees to do it. And
Hmm.
the beauty of them is you only are paying on what you take out. So you could get $100,000 line of credit just as a security blanket to have, knowing that if you ever need to access that equity, you already have that line squared away. And then if you're doing, home renovations, maybe you run into some medical bills or whatever it might be, and you take out 20,000, 30,000, you're only paying on that 30,000 that you took out of there, even though you have a line of credit for 100. So whereas the difference in it, say you took out $100,000 second loan, you're making the payment on that $100,000. You can do whatever you want with it, but you're making that payment each month
Yeah.
based on the amount of money that you took out. So, yeah, and we can dive into this a little bit more, and I'll kind of nerd out on it a little bit. But with using a home equity line to purchase the next home, it's really what you're doing with the home that you're getting that line of credit on. Because
Yeah.
if you're planning on selling in 2 months, you just want to move first, then it's going to be a bridge loan, which only a handful of lenders want to do bridge loans. But say you're converting your current home into a rental property and you take out a home equity line to purchase the next home. All we have to do is just factor in what your payment is on that home equity line plus your mortgage to qualify you. So it's really just kind of takes a little bit of structuring and making sure that we have all the pieces of what the plan is and everything. With a
Yeah.
home equity line, I mean, you can do whatever you want with the money, but we just need to make sure that it fits what the guidelines are. But there's a lot of options with it.
Yeah, I think that's cool, and I think that's something that maybe next week is what we should get into is the bridge loan.
Hmm.
It's an intimidating thing, and a lot of people don't even know what it is. It's
Yeah.
intimidating to agents, and it's intimidating to a lot of lenders because a lot of lenders don't do it.
Uh huh.
So yeah, I think that'd be a good topic to get into because like we were just tapping into, it's like we've got to get a little more creative in how we can get people into homes and how we can get people out of homes that need to get out. And I think that by providing people in this forum a chance to kind of see the options out there and ask questions live. I think that's a good idea. So maybe we'll do that next
Hmm.
week if you're okay with that.
Yeah. Let's do it.
Okay, cool.
Yeah.
Well, thank you,
Um,
man. Go ahead. Go ahead.
Yep. Yep. Nope. I was just going to share kind of some good news as far as interest rates
Oh yeah,
for
yeah,
this last week. So at the beginning of the week, we were kind of hitting some highs. We were over 8% for the national, 30-year average interest rate, a little over 8%, which we hadn't seen that in quite a while.
yeah,
But we had a great rally last week. There was some good economic data that came out. There was a lot of analyzing what the Fed talked about. So we had a great rally throughout the week. So by Friday, we had dropped down to 7.38 as a national average of 30-year interest rates, which is huge. I mean, that's
hmm,
like in a different normal market, that could take 6, 8 months worth of time to lower that much. And then so as of today, we're at 7.41. And when I say we, I don't mean our company. I just mean we as a 30-year
yeah,
fixed rate mortgage average, 7.41. So we've seen a drop over 0.5% just in a week. So we try not to analyze it too much or look into like, oh, hey, maybe we're finally starting to see some decrease in rates, but it's definitely a nice little boost for us in the housing market and anybody that's looking to buy or refinance. So,
yeah, absolutely. I think
yep,
we're going to see that week to week go up and down. I've heard
yep,
all the predictions of like towards the end of the year and things like that, and so you have lots of people guessing and a lot of
yep,
buyers guessing, which is fun to deal with. Of like waiting it.
yes,
It's always an educated guess on when to buy and sell, but
yeah. It
yeah.
feels like you're playing the stock market.
Yeah, exactly. Well,
Yeah,
hopefully this helps some people and answer some questions. Let me see any questions. No, there are no questions today.
probably too many to go through.
I know, tons. Yeah, so I just thank you for meeting up. We'll do it again next week on Wednesday, and we'll try to go into more of the HELOCs and the bridge loans and different things for buyers to have some opportunities to buy in a different way.
Yeah, I look forward to it, man.
Okay, well, have a good rest of your week, and we will chat soon.